so in love with you.
Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, so many people say that a recession in home values have absolutely no correlation, except for the most recent Great Recession in 2008, of course. And while people disregard that very important event, is beyond me. I have no idea why they do that. But I think it's really important to understand that more than likely it's the housing market and the price declines, the sales declines, and the demand declines that's actually going to kick the US into a recession. Now, personally, I want to get it over with. Enough of the smoke screens and mirrors. Let us get to the healing and let us heal right now. But unfortunately, it doesn't appear that's what's gonna happen. Call it politics, call it greed, call it whatever you want. But my main focus is, when should I purchase my primary residence for my family and I? And that's what I'm gonna try to answer today. But remember, you guys, I'm not a financial advisor. Even if we want me to be, you want me to be, I want me to be, regardless, you guys, my bio is as a realtor, loan officer, and instructor in all things real estate. So I know a lot about real estate, but regardless, this is just my personal YouTube channel. So please like this video for me, subscribe if you haven't already, and please don't leave me hanging. Shoot me a comment below so I know how you guys feel about today's video. Other than that, let's get started right now. All right, so the name of the Zillow article is Residential Investment Held Back the U.S. Economy in the Third Quarter. So let's jump into a few bullet points right now. Real gross domestic product increased at a seasonally adjusted annual rate of 2.6% in the third quarter of 2022. In the second quarter, real GDP decreased 0.6%. So this is what really is worrying me, guys. If we would have had negative GDP in Q3, we can get this over with. We can start our healing. Everyone's aware what's happening. Everyone can prepare. But I believe as a result of midterms that the data is manipulated. I'm almost positive that, because I personally have witnessed multiple data sets change, and they are months old data, especially new home construction. It's changing like crazy overnight. Second bullet point. Residential fixed investment decreased by 26.4% as new single-family construction and brokers' commissions fell. This was the largest reduction since the global financial crisis. Residential investment fell 18% in the second quarter. So all of the people that say, oh, investors are just waiting on the sidelines, no, they're not. Most investors are fleeing the housing market. Consumer spending, which makes up more than 2/3 of GDP, moderated slightly but remained strong. So again, you guys, it appears that we're going to have to reset the clock with a recession, because obviously in order to have a recession, we need 2 consecutive quarters of negative GDP. So the fact that Q3 was positive, we have to start all the way over again. Now, again, I think that's just a smokescreen. I think it's just trickery. I believe that we're in horrible shape right now. But again, because of political motivations, I believe the data is manipulated. I don't know that for sure, but that is what I believe. Let's jump back into the article. Really interesting stuff that Zillow's talking about here. As the Federal Reserve continues to evaluate the appropriate pace and cumulative amount of tightening needed to bring down inflation, new data from the Bureau of Economic Analysis show the U.S. economy grew in the third quarter after falling in the first and second quarter of this year. The moderation in consumer spending and contraction in the housing sector means the Fed's stance is successfully cooling the U.S. economy. Despite the economy's overall improvement, the housing sector showed more weakness in the third quarter, reflecting the challenges facing the housing market in recent months. Residential fixed investment, consisting of purchases of private residential structures, new construction, improvements of housing units, brokers' commissions on the sale of residential property, and residential equipment, fell by a whopping, this is huge, 26.4%. That's huge. It was the third consecutive decline in the measure, which historically has been very responsive to changes in interest rates. Residential fixed investments fell by 18% at an annual rate in the second quarter and 3.1% in the first quarter. Another downtick in the measure wasn't entirely surprising given recent developments in new home construction. Builder confidence has fallen for much of 2022 as housing starts were 7.7% lower in September than they were a year prior. New home sales were down 17% over the same period. Historically, declining new construction and slumping residential investment have each acted as early warning indicators, just like the Von inversion, but no one's listening, early warning indicators of an economic downturn. If housing market actively continues to cool, further declines in residential investments are expected. Private inventory investment is also likely to fall further, reflecting weakness in retail trade. Combined, economic growth could slow in the fourth quarter and will likely be weak over the next year. So again, you guys, they are failing to look at these economic indicators and give us warnings. I don't understand that, and I don't understand why we elect people that are not honest with us. And again, I'm not playing politics right now. I don't trust any party fully. I have certain beliefs that I don't discuss, and that's it. But again, I want you guys to win, and I don't trust these other people. So what are the indicators of a recession if they're not already obvious? Now, what I want to start is by really painting a picture of American households, because the fact is, guys, most of us are broke right now. Take a look at the savings chart. All right, guys, so here's the personal savings rate by Fred Economic Data. You can see that this was just updated 3 days ago, okay? Updated 3 days ago. Now, this is measured as savings as a percentage of your income, right? So we have now dropped. We have dropped all the way down to 3.1%. And I want to make a point. We have not had this low of a savings rate, guys, and you can't really see this. Let me zoom out. So I highlighted it right here. We haven't had such a low savings rate since around April of 2008. So we haven't been this broke since the Great Recession. How is the economy powering forward when half of America is completely broke? Do y'all see that? We're at only 3.1%. Look at where we were at during, right after COVID. We got all of this money right here. Then we got another stimulus here, and everyone just, spent that money wastefully. It's so sad, you guys. It's so sad. On 1 minute, people are thinking it's raining money. We're getting child tax credits. We're getting all this money. And then boom, we got flipped on our heads. And now we get no money and everything is way more expensive. You guys, the thing is, we're broke right now. But if that's not enough, let me show you another economic indicator that is screaming recession. And that's obviously the inverted bond yields. So normally the indicator is if this 2-year gets higher than the 10-year. So as you can see right now, the 2-year is at 4.53%, which means it's higher than this 10-year, which means the 2-year is inverted. Now, normally that's the indicator that we need to kind of warn about a recession. However, unfortunately, that hasn't been happening. Now, I want to point out the 9-month right here. Anytime in history, anytime in history, the 9-month was inverted over the 10-year, we had a recession 100% of the time. Again, 100% of the time. So you can see the 9-month is greatly inverted over the 10-year. Basically what this means is people should start buying bonds. I mean, look at the return on your investment. This is insane. But not only is the 9-year inverted, also look at this, guys. This is insane. The 3-month is well inverted over the 10-year. Now, this just happened to where it stayed inverted. We actually had a 3-month inversion maybe 4 or 5 times throughout the year, but we haven't had such a long-term inversion of the 3-month. But in other words, and look at this. This is as of today's date, the 31st at 9:14 a.m. So, massive inversion here, guys. And the reason I keep pointing this out is that that's a leading economic indicator, as well as negative GDP. So again, it's really clear if you start looking at the writing on the wall of what's going to happen next. So when do I think it's going to be the best time for my family and I to purchase a home? I think it's going to be sometime in 2023. It might be Q1 or it might be Q4. That answer is really going to depend on what the Federal Reserve does next. So the real question is, are you prepared right now to take advantage of potential great deals that pop up within the next few months to a year. And that is the only question right now that should matter, because remember, with unaffordability spreading across the nation and millions of home buyers being forced to the sidelines, that makes any current buyer that can afford to purchase the king of the housing market. So don't throw that away by buying too soon. You guys, that's my point. That's my point. Just wait a little bit. When I had a foreclosure, bankruptcy, and repo, I had to wait 9 years. So why not wait just 9 months, right? Just wait a little bit so that we can see what's going on. And that's my honest, and that's my honest thoughts on the matter. Now, other than that, guys, I really hope you guys got some value, perspective, and insights from today's video. And if you're out there investing in real estate, I wish you luck, and I hope you win.